So welcome back to lesson 2 of Why Everyone Can and Should Invest, the crash course by Charlie Cameron. And I'm going to go over some terminology here. I promise there's about 6 more content slides. It's not going to be painful. So all I need to do is just explain these terms so that it makes it easier to explain why everyone should and can invest. So let's jump into it. Stocks and stuff. Stocks simply are shares in a company. When you buy a stock, you become a shareholder and you become a part owner in a company. In fact, you can even help make decisions later on. People buy stocks in the hope that either they grow in dollar value, so the share goes from $80 to $100, say, over time, and or profits are paid out in dividends, which is a usual payment from a company. Normally it's one or the other. Company usually does one or the other, and generally they sell stocks so that they can raise funds for whatever they want to do, whether that be grow larger or change their infrastructure or make improvements, whatever that may be. Some stock names you're probably familiar with are like Coca-Cola, Facebook, Twitter, Apple, Procter & Gamble, Amazon, Netflix, Tesla, you name it. Any big company you could think of probably has stocks. So stock categorization. So this isn't super important to know a lot about to get started, but stocks can be categorized a number of ways, and this includes company size, which breaks down to the small, mid, and large cap or capitalization, sector or industry, so that's like energy or healthcare, the geographic location, that's obvious, and style, which is usually divided into growth and value, growth being companies you expect to get bigger, so their stock will get bigger, and value being companies that are sort of on sale in a way. It's hard to tell what price a company should be at, but these are generally stocks that are thought to be undervalued, so a good deal to you. So bonds. Bonds are different. They're loans you give to the government or to a company that you receive a return from. They're lower risk because they're usually backed by the government or by the company in a way, so they're usually backed by a local, state, or federal government, which is helpful. So lower risk and fewer categories. They're simpler than stocks. And then there's mutual funds. So mutual funds are just an investment vehicle that combine many stocks, bonds, or both. And the combination of stocks and bonds that a specific mutual fund holds are called its holdings. And it can be bought and sold just like stocks or bonds. And the expense ratio associated with the mutual fund is basically a percentage-based fee, and it's a cost to you because the fund is actively managed usually. These are by people much smarter than I, financial people who study this for a living, to try and make the fund succeed so that more people will buy into it, basically. One example we can make up for a mutual fund, let's call it Twitbook. So Twitbook might be 50% Twitter and 50% Facebook. So if you buy one share of Twitbook, you have half a share, say, of Twitter and half a share of Facebook. It's split across both. So usually mutual funds have many more than just 2 stocks or bonds. They usually have upwards of hundreds, maybe even 300 in a single fund, which is great for us. So that brings us to the advantages of mutual funds. They lower your risk. Even if it is all stocks, like I said, there might be hundreds in there. Usually you want hundreds so that it lowers your risks. So if one of them tanks, then the rest of them kind of hold the price of the mutual fund up. It may drop just a little bit, but the whole fund isn't going to tank. It'll still move up and down with the up and down motion of the stock market, which is just fine, but it's not going to tank because one stock failed. And then diversification, right? It gets you 300 stocks or bonds in one fund. So you're already hugely diversified. It would be so hard for someone who works every day to then also have a diversified portfolio by buying individual stocks and bonds, right? So this allows you to diversify very easily with one or just a handful of mutual funds. And it makes investing super easy. In fact, it might be even easier than some stocks and bonds through some companies or investment firms, because usually mutual funds you could set up automatic deposits for. You can automatically buy mutual funds weekly or monthly, which sometimes banks or investment firms don't let you do the same with stocks or ETFs. And they're managed by experts. Like I said, they want to make you more money so that the fund is more successful. So that's an okay thing. And exchange traded funds or ETFs, these are like mutual funds, but they're sort of They're based off stock market indexes, which are pretty well defined, and sometimes they're computer defined, but basically there's not really active management here, so they have lower expense ratios associated with them. They're traded like stocks and bonds, but you usually can't do an automatic purchase like mutual funds through many companies. But we're going to only focus on mutual funds for this course because they're more proven, more well known, and just easier to talk about, and a good investment vehicle for a lot of people. So in the next lesson, we're going to get into why everyone can invest. So we've done the terms, we've talked about investing and what it is. Now let's talk about why everyone can invest. And spoiler alert, your income doesn't matter.